Eventually, time catches up with all of us, so don't wait until the last minute to plan your ownership transition strategy. Your main options are these. 1. Internal transfer. This is the traditional method of ownership transition in the AE industry. It typically involves multiple buyers and sellers in multiple phases and is governed through a shareholders or buy-sell agreement with a stated valuation formula. Cash flow is used to fund the transition. At inception, the firm buys back shares from exiting partners while new owners obtain shares through a promissory note, with the firm essentially acting as a pass-through entity. On the plus side, internal transition provides for a seamless transfer of ownership and leadership to the next generation, and the firm's history, identity, and culture remain, for the most part, intact. On the downside, owners likely won't get paid a premium, nor will they be paid all at once. The next generation has to be successful in leading and managing the firm, or the outgoing owners will not be able to extract full value. 2. ESOP. An ESOP, or an employee stock ownership program, is a tax-advantaged share ownership plan enabling selling shareholders to receive immediate liquidity. In an ESOP, the company borrows funds from a bank or investors and then lends the funds to the newly formed ESOP trust. The ESOP trust acquires shares from the selling shareholders in exchange for cash and/or securities. ESOPs provide a tax-advantaged mechanism to transition large blocks of stock and delivers immediate liquidity to selling shareholders. On the other hand, they can be costly to maintain, and it can sometimes be challenging to convince staff of their value. 3. External sale. An external sale involves finding a buyer for your company. A buyer may be a strategic buyer, as in a larger AE firm looking to expand into new markets and regions, or financial, as in a private equity firm that will look to build value in the firm via recapitalization, then sell the firm for a profit later on. Multipliers for AE firms are strong right now, as we routinely see companies sell for 4 to 6 times EBITDA and above. External sales typically yield the highest value of all options due to the application of a control premium, which is the amount a buyer would pay for assuming control of the acquired entity. They also provide outgoing owners with liquidity and staff with additional career opportunities. The trade-offs include loss of control, a culture change, and the culture will change, and post-transaction flight risk of key staff. No exit strategy is a panacea, but if you plan well, you can maximize the advantages and minimize the risk associated with whichever path you decide to take. For more information on how Morrissey Goodale can help you plan your firm's future, call us at 508-650-0040 or visit us at www.morrisseygoodale.com. For Morrissey Goodale's AEC Dashboard Strategy Briefing, I'm Mark Goodale.